In this video, I will be sharing an amazingly simple trading system that this trader used to make more than 2 million during the 20th century. For those of you who don't know him, he is Nicholas Darvas. Nicholas Darvas was a very famous and well-known investor. He gained a lot of popularity through his book How I Made 2 Million in the Stock Market. In that book, he explained his trading methodology and traders found it easy and effective. So, in this video, we will understand that method. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss any of our new videos. With that being said, let's get into today's video. The Darvas Box trading strategy is one of the simplest strategies that I have encountered. It follows the classic principle of buying low and selling high. The strategy was mainly used for stock trading, but it can be applied to many markets. For this video, we will stick to the stock markets. Before getting into the details of the strategy, I must admit that the strategy is a techno-funda strategy. This means that the strategy involves technical analysis as well as fundamental analysis. For the fundamental part, we are looking at companies with expanding earnings, expanding profits, debt reduction, etc. These companies are good overall, and we will be looking for buying opportunities in them. Once we have created a list of these stocks, we want to look at each of them and filter out opportunities. The Darvas Box method states that the price of any asset moves from one price range to another. And therefore, we can draw boxes to mark these price ranges and trade them. For instance, in an uptrend, we will see that the price creates a range, breaks above it, and then eventually creates another range above the previous range. As a result, in an uptrend, we see rising boxes over time. Similarly, in a downtrend, we see that the price creates a range, breaks below it, and creates another range below the previous range. For this strategy, we will only be looking for buying entries. This is a swing trading strategy, and we will use the daily time frame for our trading. Now, what exactly is the strategy? The strategy in itself is very simple. We find out fundamentally good stocks and make a short list of them. Then, we will look at each of them on a daily chart and create Darvas boxes around them. When the price breaks above the box, we will enter a long position. So your first question might be, how do I draw a Darvas box? To draw a Darvas box, we first need the price to make a new 52-week high or an all-time high. After the high is created, the market must not break above the high for the next 3 days. After these conditions are met, the upper boundary of the box is set. Once we mark the high, we wait for the price to create a low. After the creation of the low, the price should not break below the low for the next 3 days. That low will become the lower boundary of the box. Thus we have successfully created a Darvas box. Now, we want the price to break above the Darvas box for our entry. At the point of entry, we want two things to ensure a high probability breakout. Number 1, we want the breakout candle to have a strong close. This means that the close of the breakout candle should be near its highs. In other words, the breakout candle should have a very minimal upper wick. If the candle has a larger upper wick, we will not enter. Number 2, we want the breakout candle to have high volume. This means that the volume on the breakout candle should be greater than a 20-period volume moving average. A higher volume on the breakout is a sign that the breakout will be strong and it will not fade away. Once both of these conditions are met, we will enter a buy trade. Let's look at some examples to understand this. Here we have the ticker AMD on a daily chart. We see that previously the price was in an uptrend and constantly making new highs. Then, the price creates this high. The next two candles stay below the high. Therefore, we mark this high as the upper boundary of the Darvas box. Subsequently, the price creates this low, and the next two candles stay above it. So, we mark this low as the lower boundary. Now we have successfully created a Darvas box. All we need to do is wait for the price to break above the box to enter a buy trade. But make sure that the price does not break and close below the box. On this candle, we see that the price opens below the low of the box, but immediately the buyers come in and push the prices upwards. The candle closes within the box. Had the candle closed below the box, that would have been a successful breakout. So we would ignore such a setup and look for opportunities elsewhere. But, in this case, the price closed inside the box and the opportunity was still valid. On this candle, the price finally broke above the upper boundary of the box. The close of the candle was right at the highs. Hence, it is a strong close. Secondly, the volume of the breakout candle was also high. The yellow line here is a 20-period moving average of the volume. We can clearly see that the volume on the breakout candle is above the yellow line. Hence, we have a high volume and strong close on the breakout candle, so we shall enter at the close of this candle. Now, according to Nicholas Darvas, the stop loss should be below the box itself. But, in many cases, that would end up being too wide, and therefore, we will need a larger profit target. Since we are only looking to hold a trade for 5 to 7 days, we want small targets and stop loss. My idea is to keep the stop loss in the middle of the box. My logic behind the placement of this stop loss is that once the price breaks above the upper boundary will act as a level of support, and in most cases, the price will never test the boundary again. But even if the price does test the upper boundary, we are still giving it enough wiggle room to make a successful retest. We will keep our targets at a 1.5:1 risk-reward ratio. In other words, our target will be 1.5 times the stop loss. And as you can see, we achieved our targets on this trade. The price move was pretty straightforward. Now let's look at another example. On this chart, we can see that the price was initially in a strong uptrend. The stock was constantly making new all-time highs. Then, we see that the price created this high. The high was not broken for the next 2 days. Therefore, we marked this high as the upper boundary of the Darvas box. Subsequently, we see the price makes a strong pullback. After making this low, the price stays above it for the next 2 days. So, we mark it as the Darvas box low. Now, we have successfully created the Darvas box. We will wait for the price to break above the upper boundary to buy. Remember, we need the price to close above the box to be considered as a breakout. During these sets of candles, we see that the price tries to penetrate through the upper boundary. But, at no point does the price close above the box. So the box was still intact. Then on this candle, we see that the price breaks above the upper boundary. Once we have a breakout, we will look for the signs of a strong breakout. A strong close and high volume are signs of strength. And as you can see, we have both the signs on this candle. The close is very much near the highs. Therefore, it is a strong close. Secondly, the volume on the breakout candle is also above the 20 moving average. The volume is not as high as the previous example, but it is above the moving average nonetheless. So it does provide us confirmation that the breakout might be real. So, we enter the stock at the close of the breakout candle. We will keep our stop loss at the midpoint of the Darvas box. And, we will place the target at a 1.5:1 risk-reward ratio. And as you can see, the price achieved our targets on this trade. So that was the Darvas box strategy. It is one of the simplest strategies that a trader might come across. Yet, it is very powerful. I suggest you backtest and paper trade the strategy for a couple of trades before putting your money in it. That brings us to the end of this video.